There is absolutely no certainty right now. Everything is up in the air. Nowhere can they find a solution, particularly with a central bank. Trying to make individuals and businesses spend even more money at a time when they should be more conservative is not going to fix anything. But as we look around the world, it's clear all central banks are moving in the same direction, down. They only have one option, print, and they'll use it until the currency is confetti. You came here for the truth, so let me unveil that for you. Today, I have a lot of different information to get into. Of course, we're going to talk about the Federal Reserve and the other central banks. Of course, we're going to look at what happened in the stock market, but I want to connect this into what's going on in the real economy. So stick with me till the end. Let's take a look at the Dow Industrials daily percentage change. You can see these incredible moves down and up that have been taking place, and having it go down nearly 10% and then the next day going up over 9% is a historic anomaly. I'll show you another chart in just a second, but I wanted to make it clear that we have had some seriously aggressive moves, and it's only getting worse on the downside and on the upside. You have to figure that this is not a healthy market. Yes, there's always ups and downs. When you look at it on a chart, it's always going to come up and down, and maybe the trend is in general going upward, maybe the trend is going downward. But when you see such aggressive moves, it should be worrisome to everyone. Here we have these two charts overlaid, and obviously this is just for illustrative purposes. You're looking at the Dow Jones between 1928 and 1932 compared to 2019 and 2020, and of course we have that same pattern where you have this first drop off, and then we see that there's this upswing as people start to buy the dip, and there's this re-emergence of confidence and so on, and then the big slide comes after that. There's no telling if we're going to enter the same situation, but I do believe that the real economic slowdown that is taking place, that's been going on for a while, that has finally made its way into the news, could really have an impact on the markets. This chart here was just what I was covering previously to give you an idea of that daily percentage change. We haven't seen something like this since 1929. It should make you think. Another week has passed and another update from the Federal Reserve. Can you believe it? They have been growing their balance sheet at quite a healthy pace. They are now at over $4.3 trillion. You know, I was looking at this for a period where it wasn't really moving up or down. It was moving within this range, and I thought to myself, what's happening here? Well, now in this case, we have seen it increase at a dramatic level. Congratulations to the Federal Reserve for doing your job, because we need to get it back to that 4.5 trillion so that we can grow this balance sheet, so that we can fix all the problems. Because if you want to know the solution to any problem, it's printing money. I just wanted to make a note here that you really need to keep an eye on what's going on with the Fed repos. If you do a search online, just type in Fed repo and look for the site that has a newyorkfed.org link. It's probably going to bring you right to this page here. You need to keep an eye on it this week. It is extremely integral to what's going to happen over the coming days and the coming weeks. All the central banks seem to be going in the same direction, and that is clearly downward. And I'm not sure if I covered this already, but one of my subscribers brought it up to me. I wanted to make sure that I did include it. The Bank of England announced an emergency cut in interest rates to shore up the economy. Policymakers reduce rates from 0.75 to 0.25. You got to think about this for a second. 0.25%. This is a historic low, the lowest level in history. We're talking about emergency levels. And what is the problem here? They're saying it's coming from outside. This is what the issue is. So we're bringing interest rates down. It is my opinion that we are looking at a global economic slowdown that may eventually become the global economic collapse. And this would decimate industries and sectors and stocks and, of course, individuals. They could easily bring interest rates down to 0% in a short period of time. Then we're looking at negative interest rates. Will they go below the line? Maybe, but you can be rest assured that quantitative easing is coming. Then they will have to go to the next level. Maybe we'll call that quantitative easing squared, which Japan is already doing, and that is buying up the stocks. They need to do so in order to support this disaster. Not every bear market is accompanied by an economic recession, but chances are high. I wanted to make this point clear because if you look at what's happening today, yes, the stocks did go down by anywhere, 20, 25% if you look at the major indexes. And this is significant because it is officially a bear market, but we did have a resurgence right at that last basically half an hour of Friday with the plunge protection team most likely being activated. But it doesn't necessarily mean that we will go into a recession. The reason it looks likely is because we are seeing it on a global level. I'll touch more on that in a moment. But when all of these different indicators are stacking up with the sales down and everything that we're seeing, it's not just retail, every industry has basically come into a halt. Surely this becomes a realistic possibility. It isn't because of the housing bubble. It's not because of some derivatives. This is a real shock that simply can't be, number one, avoided and can't be resolved simply by printing money on top of it. That's why they're so worried. That's why they're acting in this way. Pioneer of Wall Street Fear Gauge says it's now worse than 2008. I want to make that very clear. He said it's worse than 2008. Thursday's harrowing sell-off in U.S. stocks sent investors reaching all the way back to the financial crisis and Black Monday for historic parallels. But the academic who inspired the creation of VIX said that what markets are now grappling with is worse than the credit market meltdown a decade ago in some key ways. And I wanted to make this known right now. I've been covering the VIX. People are trying to just wrap their heads around, like, what does this mean for me? That's why I wanted to break this down for you. The level of uncertainty is even beyond what we saw in 2008 immediately after Lehman Brothers collapsed. The index, which reflects expectations for near-term swings in the S&P 500, has now closed above 45 for 4 straight days, its longest streak since 2009. It was at 63 in Friday trading as stocks mounted a comeback. It actually hit as high as 76. For the longest period of time, the VIX was sitting around 12, and we actually had it even lower when you go back a little bit further. To see it right now at these highs is just crazy to think about because it ramped up so quickly. Nobody expected this to happen. There were so many individuals that were shorting the VIX. I really want to know the data about that. I will definitely update you when I can. If you look at 2008, it spiked and then within a day or two, it was going down very fast. Here, it's been steadily going up instead of going down. It's more violent and it's more persistent. Very, very interesting to say the least. Let's move on. Here we have the chart that's associated with that out of Bloomberg, just giving you the data. VIX surges to the highest since financial crisis, 76 right here on the right-hand side. Nothing even comes close when we're comparing all of this back to the financial crisis. I haven't done an update about this company in a long time, but Deutsche Bank, if you can believe it or not, has actually sunk further and further. Look at what we have seen just recently. It is up as of the last trading session, along with basically all stocks around the world. We have seen it fall to 485. How low does this stock have to get before we realize there's nothing left? The market cap is $10 billion for a company that's so important, one of the global systemically important banks, and yet the market cap keeps shrinking further and further. Pretty soon all of the Money GPS subscribers can pitch in and buy the thing. It's crazy. And I just wanted to touch on this before we move on to the economic aspects, the 3 phases of bear markets. Real Investment Advice provided this chart. I really like it because when we compare these, you're seeing basically the last 3, including what we're looking at for 2020. Essentially, phase 1 is generally euphoria on the way up. Everything is so fantastic, but we have an exaggerated pull down, and this right here usually is an overreaction. People are worried, oh my God, this is it. I gotta sell sell. Some people decide that now is the time to buy. That's right, buy the dip. Many people do agree with this. They all start jumping in and stocks rise. However, we have phase 3, which is when the stocks actually decline a significant portion, which might extend over a period. Nobody knows where this thing is going, but at least we have some historical examples to give us some ideas, that's all. China automakers seek government relief after February sales dive 79%. I'm going to show you a couple charts on this, but imagine the auto industry decimated all around the world. But I want to make it very clear, this was going on beforehand. This was happening before. This isn't new. Of course, it's just gotten a lot worse recently. Passenger vehicle sales year over year, and you could see how it has fallen off a cliff. Auto sales down considerably over the last little while. Basically, it looks like as of the beginning of 2020, it's been practically non-existent. And then the real deal, the real information that I really wanted to show you today. So if you stuck with me up until this point, thank you very much. This is really key here. OpenTable, you might know this company, they provided this data and it's really, really telling about what's happening. I like these real indicators because we're going to be able to determine what's happening, not by looking at PE ratios and stock prices, but sometimes we have anecdotal evidence. We have what I call second or third tier data that tells us a lot more about what's going on. This gives us the restaurant performance data in the country level, the state level, and the city level. I personally think that if we look at it on a country level, it's probably too wide, it's too broad, but you can see it here for yourself. In general, what we're noting right here, this is the year-on-year change in diners. Essentially, over the last month, how things have progressed, or maybe you want to think about it like regressed, whatever. Things may have not been in the best situation all over the place, but clearly as you move from left to right, you start to see a lot more red. United States, for example, as of March 13th, minus 36%. If I go down to the state level, you're going to see different levels, whether depending on where you're from. United States, just as an example, let me try and fix this up here. We're looking at New York, right-hand side, at the bottom, minus 54%. This is extreme. Now that happens to be just one place. You could say, well, it's not like that here. Look at it overall. All of the different states. We have a lot of green in this area and a lot of red right here. The trends are very clear. This means that people aren't going out as much. They're not eating out as much. They're stockpiling food. They're worried about what's going to happen, and that's going to have a real impact on the global economy. This is the chart here. If you want to pause the video, essentially showing us what we were just talking about. Here's another one of major cities around the world. The data doesn't lie. The global economic slowdown may very well become the global economic collapse. That's all for this video. If you found that informative, hit that thumbs up button. You support me by clicking one button. Thank you very much. If you want to find me on any other platform, it's at The Money GPS. I do daily content on Twitter and on Instagram that is totally different from what you see here. Check me out over there at The Money GPS. If you want to be able to sell online, which obviously right now especially is very important, check this free e-course out that I created at the AmazonGPS.com. If you want to learn about money fast, don't go anywhere else except these two books. They will teach you everything you need to know. Check them out at the link in the description. You want to know what you can do. What are the solutions? What do I have to do at this point? Have you seen this before? Click on it. It's going to bring you into a set of videos that I believe are extremely important. I'll see you there.